Good morning, everyone. Hope everyone had a fantastic Thanksgiving long weekend. My name is Steve Tabrizi. I'm the Chief Operating Officer with the Remax Hallmark Group of Company. Today is another segment of the Remax Hallmark Live, which we focus on the Canadian economic state of the real estate post-election. And I'm excited to have an amazing guest, Rishi Sondhi, which is the TD Bank Real Estate Economist. He's with us today. Before I give a brief introduction of the Rishi, we will do this on three parts. Rishi will give an overview of the real estate market, and then we will have a discussion between Rishi and I regarding a series of the questions that was sent to me earlier to ask him about his perspective of the market. And then we will open the floor, or perhaps we should say we open the air to the individual that they are watching, that they can ask their question. So without further ado, let me start. Rishi Sondhi joined the TD economic team in 2017. His main responsibility, including analyzing and forecasting provincial economies and housing market. Rishi has contributed to a variety of the TD's publication. Prior to joining TD, Rishi worked at the real estate consulting firm where he researched and forecasted housing market across Canada, as well as provincial and municipal economic activities. Rishi also has forecasted experience with the Royal Bank of Canada, the Ontario Construction Secretariat, CMHC, and another major financial institution. In the latter role, he forecasted the economic performance of the both US and Canadian economic. Rishi holds an honor degree in economics from the University of the Western Ontario, and I'm pleased to have him this morning in our live broadcast. Rishi, welcome to our live broadcast.
Oh, thank you so much, Steve. So quick question, can everybody see my screen?
I can see it, perfect.
Wonderful. Okay, so we'll go ahead and we'll press on. So as Steve said, my name's Rishi Sondhi. I'm an economist with TD Economics. Thank you so much, Steve, for having me on this web chat this morning. It's a real pleasure to be here. Thanks for organizing the event. I'm going to go through some slides. I have a few slides, maybe about 10 minutes or so. So not hopefully won't take up too much time, but I think visuals are helpful in telling a story. But before I jump into my slides, I'd like to start with a joke, if I may, in honor of the Maple Leafs starting their preseason. So when I pass away, I want the Maple Leafs to bury me so they can let me down one more time. All right, so let's go ahead and move on. So let's start with Ontario's economy. So Ontario's economy is recovering from the pandemic recession. So last year, economic growth contracted as a result of the COVID-19 pandemic. And Ontario's economy is recovering this year. However, the recovery is lagging some of the other provinces. So why is that the case? Well, the COVID-19 pandemic has been more severe in Ontario relative to other jurisdictions. So the measures to control it have been more severe for businesses here as opposed to other provinces. So that's one factor. Another factor is that the automotive sector is having a real tough time getting semiconductors to produce automobiles. So auto production has just tanked this year. And that's really an Ontario story because that's where automotive production takes place. So those factors aside, Ontario's economy, again, is recovering to a decent extent this year. And a big part of that is housing market. So home sales, construction, that's provided a tremendous boost to overall economic growth this year. So that's an important story to tell. Looking ahead to 2022, we expect economic growth to accelerate, so stronger economic growth next year. And there's a few factors that underpin that in our view. First of all, the semiconductor shortage issues that are plaguing the automotive sector, we think will ease. Also, we think population growth will pick up next year, which will help ease some of the labor shortages that many businesses across Ontario and Canada and the US and around the world are dealing with at the moment. Also, we think consumer spending will be pretty strong, and that'll help underpin overall economic growth. So turning now to our expectations for the Bank of Canada, we expect the Bank of Canada to start raising their policy rate by the end of next year. So sometime in the fourth quarter of next year, perhaps October, they'll start pushing their policy rate higher. So why wait so long? Why not push the policy rate higher earlier? Inflation is quite robust. Economic growth should be strong next year. Well, it really comes down to slack. So when the Bank of Canada, and actually I started my career there, but at the Bank of Canada, when policymakers get together, they talk about the amount of slack in the economy. So what's slack? Well, they say, okay, the economy should be producing this much, and then they look at what the economy is actually producing. And currently, we have a gap between what should be being produced and what is being produced. So policymakers, the Bank of Canada, is not going to want to raise interest rates until that gap is closed, which their estimation and our estimation will happen at the end of next year. So that's why they'll wait before they start raising interest rates. So I just want to take a minute to talk about what we've been through with respect to Ontario's housing market. So the chart on the left shows Ontario home sales, and there's two periods that are sort of highlighted as comparisons. So one shows the peak home sales in 2017. So the first arrow there shows how high we got in terms of home sales in 2017 during that bubble that we all remember so, I don't know, fondly, but we remember it. And let's fast forward to March of this year. So sales were much, much higher in March of this year. So they peaked much, much higher this time around relative to 2017. So sales were about 40% higher in March of this year compared to the 2017 peak. So what we've been through just absolutely blows the 2017 experience out of the water with respect to home sales. Turning out, well, it's a similar story for home prices. So in 2017, during that bubble, home sales increased by at a peak of 30% year on year. In March of this year, home sales were up 46% year on year in Ontario. So again, dwarfing the 2017 experience. So the question becomes why? Why, has housing demand and home sales and prices been so strong? I mean, we had the COVID-19 pandemic, the unemployment rate skyrocketed to a record level. We had a recession last year. Why has housing demand been so strong? Well, to us, it really boils down to the type of jobs that have been lost during the pandemic. So the type of people, the type of workers who have lost their jobs during the pandemic and have stayed unemployed are those who are younger workers working in the service industries like retail, restaurants, accommodation, arts, entertainment, recreation, these sectors. So these younger workers tend not to be homeowners, nor are they in the market for ownership housing. So ownership housing demand hasn't really been impacted because those who are homeowners or who would buy a home have by and large kept their jobs during the pandemic. Also, when the pandemic hit, the Bank of Canada, the US central bank, lowered their policy rates to basically zero very quickly, and that put downward pressure on Canadian bond yields, and then mortgage rates followed suit. And that unlocked tremendous affordability for potential home buyers. So I just mentioned that, what we've been through peak sort of dwarfs 2017 in terms of experience. However, March of this year was the absolute peak of the mountain in terms of sales. And that March level, quite frankly, was unsustainable. We just don't have the population base in Ontario to sustain that level of selling. So the market has started to cool. It's cooled for several months now, and it's cooling to still healthy, but more sustainable levels, I'll say. And this cooling has taken some of the froth off of price growth as well. When you look at markets, like important markets in Ontario, the cooling that we've seen in March has really been in markets like, Waterloo, Hamilton, and Barrie, and less so in the GTA and Ottawa, although we still have seen some cooling. So why is that the case? Well, in the GTA, for example, condos make up a larger share of the overall sales pie, and condo sales are actually increasing. So the real weakness has been the single attached market, and that's relative. Like there's more single attached homes on a relative basis in places like Barrie and Waterloo and Hamilton. So that's why we've seen a steeper cooling there. So that's a quick lay of the land with respect to what's going on now. The question becomes, where are we headed? So let's look at our forecast for Ontario home sales next year. This year's almost done, so let's focus on 2022. We expect home sales to come off the boil, so not be as strong as they were sort of in this frothy year that was 2021, but still remain pretty healthy. So we think the market will be pretty healthy, and we envision sales levels being higher than what we saw in 2020 and higher than 2019, just not as high as we saw in sort of the supercharged year that was 2021. So why do we expect home sales to come off the boil relative to 2021? Well, a big reason stems from the fact that we think Canadian bond yields will trend higher moving forward. So as I had mentioned before, we expect the Bank of Canada to raise their interest rate, but that won't happen until the end of next year. But we think bond yields will go up before then, because bond yields can move independently of what the Bank of Canada does. So when the Bank of Canada raises their policy rate, that'll put upward pressure on variable rate mortgages, but fixed rate mortgages respond more to the bond market. We think bond yields will trend higher well before that, reflecting inflation expectations, growth expectations, and what happens to interest rates in the US. So as Canadian bond yields move higher, mortgage rates may respond, which should lower home sales to an extent. But as I mentioned, home sales should remain healthy. So why should they remain healthy? Well, job growth we think will be pretty strong next year, reflecting strong economic growth. Ontario's economy has already recovered the 1.1 million jobs lost in last April and March during the worst of the pandemic. So that's a pretty good news story there. Also, what's interesting is that Ontario's households are sitting on a bunch of savings. So what happened during the pandemic is that services industries were shut down. You couldn't get a haircut, you couldn't travel, you couldn't go to a restaurant, you probably didn't buy too many clothes, perhaps some underwear, whatever the case may be, but generally not. So that basically forced households to save some of the money that they would have normally spent. And now households are sitting when you aggregate that up, that translates into a lot of savings. So households are sitting on a big chunk of savings, some of which we think they'll push into down payments, which will support housing demand. Also, we expect population growth to pick up next year as elevated vaccination rates in Ontario and Canada as well, alongside policies such as vaccine passports, which have been implemented or will be implemented across all provinces in Canada, should keep the virus at bay to an extent and allow our borders to reopen more robustly or remain open, and that should facilitate stronger population growth. Turning now to home prices, zeroing in on this year, when it's all said and done, we think home prices will have gone up by about 22-23% in Ontario. So absolutely phenomenal home price growth this year, absolutely ridiculous. Looking ahead to next year, we think home prices will continue to climb, but nowhere near the rate of growth that we saw this year, but still positive. So home prices should remain elevated and growth should be positive. So why do we think home prices will continue to climb even after such a strong 2021? Well, it's really because markets are very tight. There's just not that much supply to meet the demand that we expect to see next year, and that'll keep home prices growing, albeit not as robustly as we saw during this year's surge. So that wraps it up for me. Thank you so much for listening to me, and I'd be happy to turn it over to Steve now.
Thank you, Rishi. But that was a very fast track of the economic overview. Glad to hear your perspective. So let's start by, I guess the title of today's topic was the policies of the post-election. I guess I'm sure you, among other Canadians, heard during the 37 to 40 days of the election campaign, politicians from the different parties, they made great promises to rectify the issue of the supply. So how do you see now the Liberal again back in the power for perhaps the third term? What's your perspective of Mr. Trudeau's policies in terms of there is a big discussion about the primary residence capital gain. There is a big discussion about the open bidding. There is a big discussion about incentive that they are offering, variety of the incentive to first-time buyer, or also seizing the foreign buyers. So do you see any real impact of this policy, if implemented, impacting the Canadian real estate market, or do you see these are just a politician empty promises?
Okay, it's probably a bit of an A and B, to be honest. So I guess one thing that I think we all know is that it's a Liberal minority, so they'll have to get the NDP on side if they want to produce or if they want to push any policy through. So in that respect, it's important to understand what the NDP wants as well for their housing policy, so that we can see where the two parties are aligned and we can kind of understand what's likely to go through. So the NDP wants to see additional supply as well, but they want it in more affordable housing like co-ops and the like, right? So the Liberals want more supply, but they want more missing middle supply, I'll call it, townhomes. And I'm assuming they haven't really articulated, but that's what it seemed like. And the NDP wants more supply as well. So we think that means I think we'll see more supply moving forward. And just staying with supply, it takes time for supply. Like it takes time for a home, a lot to be sold, then to be built, then to turn into resale supply, many, many years, right? So at least in the resale market, all these supply measures really aren't going to start impacting on affordability until maybe 2024, 2025, assuming they start in 2022, right? Which is what the Liberals' costing plan said they would. So that's an important point. Yes, they're interested in boosting supply, and I think they'll be successful to an extent. They've already have been successful in boosting supply, so why not? Why wouldn't they continue to do so? The NDP and the Conservatives are on side, so that should be something that progresses. But again, supply won't increase meaningfully for a few years now. So that's one thing. Second thing is that they have a lot of measures to help first-time home buyers. They have, basically a savings account which works like a TFSA, but then when you withdraw money, it's tax-free. So that's actually a pretty cool and could potentially be a useful savings vehicle for first-time home buyers. Problem is it's only capped at $40,000, so it's not going to be that helpful for markets like Toronto and Vancouver, which are the more pricier ones. It'll help more so in Montreal and Edmonton, these areas where prices aren't more expensive, but it'll certainly boost or help boost housing demand there. They also have some tax credits for first-time home buyers. The net result of all of this will be probably an increase in demand from first-time home buyers from the savings account and the like, and that'll push up prices to an extent. They also have a pledge where they want to raise the minimum insurance cutoff from $1 million to $1.25 million. So as we know, if you want to buy a home that's $1 million or more, you need $200,000 down for down payment. So they're changing that from $1 million to $1.25 million, which will unlock a lot of demand. So in Toronto, the share of homes between 1 million and 1.25 million is about 10%. So there's potentially 10% of the market. Well, maybe not actually 10% because it's insured mortgages. So insured mortgages is a third of the market. So about 3 to 5% of the market could be impacted by this policy. So that'll raise demand as well. So there's some demand enhancing policies that are part of the Liberal plan. But the thing is that they want to improve affordability, but at the same time, they want to stoke demand. So if you raise demand, and at the same time, supply is not going to respond for many, many years, that means in the near term, affordability is going to erode, which is the opposite of what they want for first-time homebuyers, right? So that's not great. So there'll be some affordability erosion, but at the same time, there'll be some offset for housing demand from the fact they want to ban foreign buying. So they have these demand boosting measures, some of them, and they have these demand suppressing measures, the foreign buying ban, for example. So foreign buyers are about 2% of the market. So net, we think that there'll be a modest near-term demand boost and a modest near-term price boost because, again, there's offsets there. But the supply relief won't come for a few years yet, right? So overall, there's lots of stuff that they've promised, but it won't amount to much, at least in the near term, we think.
Great analogy. So what's your take on the capital gain? That's a big topic, which I know Mr. O'Toole was really hammering Trudeau during the debate in terms of the capital gain. And I think he's worried a lot of Canadians about their biggest saving of the real estate assets.
Yeah, I mean, that was a little, political gamesmanship, I'd say, on the part of Aaron O'Toole. It's not technically correct that they're going to, just put a blanket tax on principal residences. The tax is that you have to, like, if you sell your home before a year, what they're proposing, which I'm not sure will go through, quite frankly, it will require the blessing of the NDP to kind of push that through, and it remains to be seen whether or not the NDP will support it. They probably shouldn't, but maybe they will. Now that said, you have to hold on to if you sell your home before a year's up, that's when you pay the tax. But if you have a legitimate reason, like if there's a death in the family, if there's a divorce, if you change your job, if there's a life circumstance that really matters, you can be exempt from paying that tax under the Liberal platform. But again, it's not a policy as yet, so we'll have to see if it gets implemented. I'm not sure if it will.
I do agree with you. I think it's basically a suicide tool for the Liberal Party. I don't think so they ever go through that route. You talk about in your presentation, you talk about unemployment. I'm very happy. I heard a few days ago, the latest report came out and we are now pre-pandemic. Basically, no job losses. We are sitting at about a 5.5 point of the unemployment rate in Canada, which is amazing. But now, on the other hand, we are also now, because of the vaccine policies that is coming across federal, provincial, and private sector, we are also hearing the greatest concern for employers, the shortage of the employees, shortage of the talents. So, and that's one aspect of it. The other aspect, we see a huge appetite for suburbs. So a lot of people, particularly millennial, they move to the suburbs. And some, they probably now realize maybe they moved too far and they were counting on a hybrid model of offering by their employers, which some happening, some not happening, because the reports are contradicting each other, because they're saying that productivity of the employees is not the same as before. Connectivity is not the same as before. What do you see as a long-term impact on job market? And it seems we came through the COVID with the massive job losses. What I see, we are now going with the shortage of the employee, which Canadian economy never faced that. Now we are actually looking for people to come and work for us. What do you see the impact on the economy? What do you see impact on potentially real estate, perhaps migration from a large urban center to the suburb?
Yes, that's a great question and like excellent observations. It's kind of funny, eh? Like, oh, everybody lost their job, but now we can't find enough people. Yeah, you're right about that. You know, it's so this labor shortage, as I'd mentioned before. I mean, you know, it's not, it's definitely a thing. It's not just something that businesses in Ontario are struggling with. It's around the world, and it's going to be with us for a while. Unfortunately, and I say that using the U.S. as a template. So the U.S. is a little bit ahead of us with respect to reopening. So they reopened in March and reopened in June, July. So that means we have 5 months of data for the U.S. So we have 5 months that we can sort of assess whether or not the labor shortage situation in the U.S. has improved as a template for Canada. And in that 5 months, it hasn't. So using the US as a template, we can expect labor shortages to persist to Canada at least for the next 5 months or so, but it will likely be even longer. So that's an issue, and unfortunately, that's something that businesses are going to have to deal with. So where do these labor shortages come from? Well, there's government generous government benefits. In some instances, you know, the government is paying, or was at least during CERB, and much of the CRB was paying people equal to or more than they're working in their old jobs. So that's one thing. The second thing is that there's probably some virus fears as well. The pandemic is still with us, so people probably don't want to take up jobs in restaurants and the like, because those are high touch industries where you have a lot of face to face with a lot of people. Also, we think that people have taken the pandemic as an opportunity to reskill. So you know, you got laid off. You've been unemployed for a while. You don't want to go return to your restaurant industry or your whatever type of job it was. You've reskilled and now you're re-entering the labor market. So it takes time for that process to play out, like you know, applying for jobs and employer match, right? So that takes some time too. So we think you know, that's holding the process well. Look at, again, turning to the U.S. as a blueprint. It was kind of interesting because half of the states in the U.S. Opted out of the federal government benefits early, and the other half didn't. So it provides an opportunity for us to compare what the labor market outcomes of the two industries. So for the states that opted out early and weren't receiving the government benefits, their consumer spending fell, which makes sense. The labor force participation picked up, which also makes sense because they're not getting the benefits, but they're looking for jobs. But the employment difference between the two groups wasn't that pronounced, which means that people weren't just returning to their old jobs; they're looking for new jobs, and it's taking time. So we think that will take place in Canada as well. And what that means for overall economic growth is that it will slow the rate of economic growth in Ontario that we think, but it won't cause a recession or anything like that. The reason why we're having labor shortages is because demand is so strong. If there was no demand, then we wouldn't have labor shortages. And I know this because when you look at the transportation industry, for example, they're not struggling with labor shortages because the pandemic's hammered the transportation industry. So it's really industries where demand is very strong. When we have strong demand, a recession is unlikely. So slow economic growth to an extent, but you know, it won't derail the recovery or anything like that. And next year we expect population growth to pick up, and that'll help ease some of the supply concerns that we're seeing. I mean, these things can't persist forever.
Great.
Oh, I'm sorry. I'm sorry.
Response.
Sorry, Steve. That was only one part of the question. The second part of the question had to do with the suburbs. So you're absolutely right. There's been a lot of demand in the suburbs, Barrie, Kitchener, Waterloo, places like that, they typically get demand anyways, because those are commuter towns and people, they start in the city and they move there. But it's really been heightened during the pandemic, and it's really the race for space. People were looking for detached housing because of work from home and the like, right? Well, the thing is that trend is reversing now. So we're seeing weakness in the single attached relative to that supercharged earlier rate, and the condo sales are actually picking up as we speak. So, as you were mentioning before, there's the return to office. Some of that, so some of the strength that we saw in the single detached is actually reversing. And moving forward, like for example at TD, our mandate is to return to the office in 2022. So if that becomes more entrenched, then that means condo demand is going to even pick up further, and we have that embedded in our forecast. That's actually our expectation. So single attached activity is very, very strong, albeit not as strong as before, but it is cooling, and condo demand is picking up. So there's that. There was the rotation of the suburbs, and there's sort of a rotation back going on right now. But as you say, because of the hybrid models, some of that suburb demand is here to stay.
It's a cycle that we face in real estate constantly. Every time the detached or freehold, we call it semi-townhouses, picked up in our industry, it had a momentum for a few years, and then back to the condo. Yeah. How do you feel about employers now, because of the massive talents that is really residing in suburb? Do you see in a long term, in order to probably manage, or maybe short term or long term, to manage the recruiting of the talent, would you foresee that the companies and corporation, maybe they relocate their operation or some of their massive head offices to the areas that the transportation and traveling from the employees, from their residents to those, the work of place will be a lot easier?
Okay, so you're asking as to whether companies will relocate to places outside of Toronto where transportation is still sort of accessible?
Yeah.
Let me think about that. I think that the trends that we're seeing now would have to be sustained for a long period of time. I think there would have to be many years of businesses observing that people want to live in the suburbs, and having some time to sort of understand how this hybrid model is going to impact their business before they make any sort of decisions like that. I still think Toronto has an extreme draw as a market. I mean, when immigrants come to the country, most of them settle in Toronto or Vancouver, or in lesser extent Calgary and Ottawa and the like, but mostly Toronto and to some extent in Vancouver. So that's really where the talent is flowing through to, right? Toronto is obviously still a global city. And let's talk about the data. So the share of condo sales in overall sales is returning to where it was before. So it's not, we're seeing that we haven't seen that as yet, basically, right? And and this is sort of the height of that frenzy. So if things normalize, it'll be tougher to sort of make that business case. Those big head offices like TD and BMO and there's lots of in the financial district, Altus Group, so on and so forth. They're there for a reason, and it would be extremely, maybe they'll set up some branches or something like that in the suburbs. But I don't think that they'll necessarily relocate. I mean, one thing I guess it has going for it is that rents are relatively cheaper in some of these other suburbs. Commercial rents are relatively cheaper in some of these suburbs than they are downtown. So that's a cost savings. But I do think they'd have to at least assess how this hybrid model is going to impact their business before they make any of those decisions.
Great observation. You talk in your presentation about that you forecast that the federal government start raising the interest rate by the fourth quarter. There are talks, and also there is a concern out there now about the inflation rate. We have seen the inflation rate is rising at about 4.1%, which is above the norm that the federal government and economists like yourself would like to see it in the range of about 2.5, below 3 point. And now we see also the stimulus packages still continue. Don't you see if the federal government dropped the stimulus packages, that perhaps in order to create affordability, maybe they will trigger the increase of the interest rate earlier than the last quarter of the 2022?
Yeah, there's definitely some risk to our forecast. it really it depends on the amount of slack in the economy. And this is not, it's sort of a theoretical funny term, but this is how the Bank of Canada makes their decisions. They assess the amount of slack in the economy because slack is an important predictor, or their measure of slack is an important predictor of inflation. So underlying inflation, what we're seeing now is sort of a combination of underlying inflation and one-offs that are driven by the pandemic. So these one-offs that are boosting the inflation rate should probably come off. So I'll just give a quick example. Like our gas price forecast, our crude oil price forecast for next year sees oil prices holding relatively where they are as supply from the U.S. and the OPEC countries comes more online to counter the robust demand. So we see prices holding at that level, which will take some of the steam off of gas price growth and moderate inflation. Some of these are just a function of the pandemic, and some of them are real underlying inflation. So when the Bank of Canada targets monetary policy or wants to do monetary policy, they want to look at underlying inflation. And underlying inflation is driven to a large extent by this slack in the economy that they measure. So this slack, there's still a lot of slack in the economy. Think about it this way: we recovered our pre-pandemic level of employment in Ontario as of September, but without the pandemic, the level of employment should have been much higher, right? So we haven't gotten back to that what it should have been. We're only at where it was, right? So there's a lot of still ground to make up before the economy is fully healed. And so the Bank of Canada is cognizant of that. So we think that'll stay their hand with respect to interest rate increases. But I agree with you that the risks perhaps are tilted to an even sort of earlier move given inflation and the fact that economic growth could be robust.
Talking about economy. So yes, unemployment recovered. Yes, the GDP has recovered pre-COVID, but there is an underlaying on the industry such as hospitality, restaurants, that really has suffered and just are sort of reviving on a momentary level. But deep down is a major issue in those hospitality and travel industry. Do you foresee any problem in that industry facing challenges when we are sort of back to normal life and routine because of the debt that they have accumulated and they have created?
Yes, 100%. That's a great observation. They've tapped those government programs more than other industries because they've had to sort of stay alive. The combination, like the restaurant industry, is the industry that is struggling the most with labor shortages right now. And there's also the vaccine passport. So, what is it? 85% or so, I think 87 or 85% hasn't gotten their second dose of the COVID-19 vaccine. So that's of the eligible population. So that's about 15% of Ontario's population that can't walk into a restaurant without, basically, unless they forge their COVID-19. So that's a whole share of people that can't eat at a restaurant. So they're facing that. They're facing terrible labor shortages. They're facing people that don't want to get back in the restaurant industry because of virus fears, and they're struggling with a lot of debt. So it's a very bleak outlook for that industry, quite frankly. That said, we don't think all is lost. When you look at what's going on right now on the ground for those industries, there has been some encouraging recovery in output and employment in those industries as reopening has really, like, you see it when you're around in the summer. You saw the patios were like packed full of people, right? So there's still a lot of demand for that service. It's just how can they supply that demand with such an extreme labor shortage? So there is recovery. We think that the recovery in that particular industry, or those high touch industries, I'll call them, will take like a lot longer than the rest of the economy. So, and that brings up an interesting point about employment. So we're back at our pre-pandemic level for employment, but not every industry is. Like some industries are doing better than others. So in the aggregate, we're back. But like IT is doing really well, financial services is doing well, real estate is doing well. Like some of these industries are doing really, really well. Public services because of all the government spending, and then some industries are lagging, like restaurants and like employment at museums or Ripley's, believe it or not. Fitness centers, all these places, right? So they will recover. In our view, it'll just be much more drawn out.
Great. So let's just dive into the condo market. So we noticed the condo market really suffered probably for 2/3 of the 2020, and then late 2020 and the beginning of the 2021 rebounded very strong. rental market, which was falling off the sky, now it's better than even pre-COVID. Multiple offers is happening. We see massive launch of the new project by the developer. Are you concerned with oversupply of the condo market in a long run? And we are practitioners in this business. We are noticing that a lot of people, they saw the success of the condo market over the course of the last 10 years. And it's been now a vehicle of the real estate investment fund appreciation. Let's buy a condo, let's put a 20% deposit, and just before the closing, let's just flip it doing that. What do you see the risk in the condo market?
Yes, all those things that you mentioned are all risks. You know, I guess there's a few things that I'll talk about with respect to this. So in terms of, I would say, overbuilding, the point about overbuilding, there's the number of condo units in the Greater Toronto area is at or near a historical peak as we speak. So that, from a supply perspective, that could be concerning. But then when you look at the amount of completions, so the amount of these units that are actually being completed and put on the market, that hasn't changed much. So we're building a lot more, but the rate at which we're completing them, because of probably municipal red tape and things of that nature, hasn't really changed that much. So from an oversupply perspective in the aggregate, there's less risk there, as quite frankly, because we're not as efficient as delivering new supply as we are sort of starting it. So that mitigates some supply risk there for the market in the aggregate. I agree with you that investor demand is picking up. I mean, clearly it is. Publicly available data is quite lagged in terms of gauging the amount of investors in the market. But even that is showing a pickup. So it's probably near or at where it was, say, in 2017 as we speak. But still, at the 2017 peak, when you look at some data, it's about 25% of sales, which is a big chunk of the market, but it's not, 75% of that then is not investors. So it's like, just regular people like you and me who are not, are just trying to buy a principal residence type thing. So the trends that we saw in the pandemic were really driven by people that weren't investors, although investor activity picked up. The trends were driven more by people that were just looking to buy a home. The concern for me with respect to investors, again, because it's ticking up, and even 25% of the market is a big share of the market, is that prices go up when investors buy, right? So that obviously may crowd out the ability to first-time home buyers to get into the market because affordability is that much worse. So that's a negative. But on the flip side, for a positive, they're buying condos and then they're turning around, they're renting them out. So they're providing a source of rental supply. So that's an important positive of this investor activity. So it's pretty nuanced, On the one hand, affordability is rewarding, but on the other hand, they're providing supply, and the overbuilding, because we're so inefficient in turning what's being currently constructed into actual new supply, because we're so inefficient, the overbuilding hasn't translated into massive price declines or anything like that. So we think that the risk of a price drop as a result of oversupply and overbuilding is diminished.
Great. You just mentioned about that you're obviously, we don't have a concrete stats in terms of the foreign, which I like to call them Canadian non-residents or Canadian expat, which are basically working overseas, but they have some sort of a residency in Canada. Do you see a concern with that group, although it's a small portion? Are they the caveat of the pushing the prices to the higher limit versus the 75%, as you suggested, that are the actual true Canadian? Do you think with the new measure, if the federal government implement in terms of the higher tax rate, or maybe not allowing 2 years period for the non-residents or foreigner to invest, do you think it will impact the condo prices?
Yes, I do. I think it'll reduce demand for those units. So yes, I think it'll impact condo prices. But I guess there's a few things to mention. First of all, if you look at provincial government data, I mean, it's government data, so you got to kind of take a grain of salt. Provincial government data specifically, but their data would tell you that foreign buying or non-resident, Canadian expat buying, is about 2% of the market. So it's not a huge chunk. But they do, in places like Toronto, they do tend to buy, obviously a lot of condos. for example. So that'll even if it's only 2% that gets flushed away, that'll still obviously impact condo demand. But because it's only 2% of the market, that won't be enough to really cause, a steep drop in condo prices and the like. Particularly because the other 98% of the market should be doing fairly well. When I talked about 25% investors being 25% of the market, foreign buyers overall about 2%. So the rest of those investors are like domestic investors. So people that live in Canada, residents that want to own a second property and sort of invest, rent it out for that purpose. So there's a lot of demand coming from domestic buyers as well. So that domestic demand from those investors, the demand from just people that are looking for principal residence, the demand from the population growth is picking up, so students are returning, immigration should pick up. So all those people, obviously, when they come to the country, they rent. So that'll boost rental demand, which will boost, demand for condo sales, of course. So there's a lot of offsetting factors, but you're right for sure that the non-residents, if they were banned, condo prices would go down, or not go down, but they wouldn't increase at the same rate. The rate of increase would be slowed.
So two last question. And these are my hardest question from you. So everybody is concerned about the massive debt that the federal government, provincial government during the COVID and pandemic have created. I firmly, on a personal level, I believe that although the Canadian nation has done great in terms of the vaccination rate, but I think the COVID or other type of the viruses related to COVID, the different variant, going to stay with us for years to come till the global community really get to the 75% of the vaccine rate. So every Canadian younger generation, in particular with the younger children, such as yourself, are worried about the massive debt that is created. What's going to happen to the younger generation? Do you foresee at all, as an economist, this is always $1 million question, does the government ever going to have the ability truly and genuinely balance the book?
Not the Liberals, not the Liberals. I don't think. They don't. They don't really have an appetite for that. I don't think the public really has an appetite for that. At least in the short term, or I guess the better way to say it is that the public has become more used to extreme deficit levels. So if you're, if outside of the pandemic, if they're running a deficit like this, they'd be, run out of office very quickly, right? But because of the pandemic, people are getting used to these eye-popping deficit figures. So they have some runway in that regard to kind of keep spending. Will they ever balance the budget? I don't think so. I mean, their platform doesn't envision balancing the budget for the next 5 years or so, right? So at least that time, they're not looking to do so. Now the question becomes, what's the downside of doing that? Well, of course, if the debt is high, that could burden future generations with some issues. If interest rates go up, then the debt payments that the federal government is facing could go up, and that could crowd out other spending, and taxes could go up if they decide that they want to narrow the deficit there. So there is definitely some issues. There's definitely some challenges. The good news, I guess, for the government is that rates are still low, and they've locked in a lot of their debt at long maturities, right? So even if interest rates go up, they're still protected. They still have locked in their debt at low levels, which is good. So that's one thing. The second thing is they are entertaining tax increases. So they want to put tax increases on banks and insurers. They have to get the support of the NDP. So the NDP wants to tax everybody, right? So some tax increases, I think, will, if they want to go the route of reducing the deficit, they'll probably be able to push some of them through for some of the the higher income people or banks and the like, right? So that'll help if they want to go that route, but I don't think they really want to go that route. And they indeed, in their fiscal plan, they've said that they don't want to balance the budget for the foreseeable future. So no, I don't think so. And I think Canada will be stuck with the debt for a long period of time. Good news, I guess, good or bad news, is that countries all over the world, the US, Europe, everywhere, Asia, all of their governments have stepped in to varying degrees to help out at least advanced economies, help out their populations. So all of them have massive debt. So if you're an investor looking to buy a government bond, you can look to Canada's still not bad when you do that international comparison. So that takes some of the negatives, I guess, stink off the fact their debt levels are so high, and the budget is unlikely to be balanced for the next several years.
Very good. My last question. I'm sure economists are always frustrated, particularly in your area of the expertise, real estate. The $1,000,000 question has always been a supply and demand. So, and us as a real estate practitioner, sometimes on the ground, we feel what are the real solutions are. So you're the guy that is pointed tomorrow morning to solve the problem of the supply and issue in the Canadian real estate. What would be your steps? What would you advise the government to do to really systematically, for at least a 10 years period, game plan and a goal to really increase the supply and create a balanced real estate market? A lot of people, they think the realtors, they love the frenzy that we have in our market. Frankly, we don't. We like the balance the market. We like the stability. We like the sustainability, because with the sustainability and balance is a normal growth and there is no surprises. With the markets such as this year and late last year, we are always worried what's going to happen the next quarter.
Yes, that is that's a great question. What would I do? If I'm being realistic, I'm not very. Let me just say I'm not an optimist when it comes to turning, in terms of increasing supply. I mean, they've been talking about increasing supply for at least 15 years or so, and it hasn't really happened too much. So I'm not that optimistic. That said, if it were me and I had to make decisions on that, what would I do? Well, the federal government, the provincial government owns a whole bunch of land. So I would release those lands for real estate for development, because I own them. I can, and I'm the government. I can zone them quickly, and I can get them I can produce supply that I want to produce, right? So that the conservatives that were actually, like, they had that on their platform. They said, we have a whole bunch of land. Let's use it to increase supply. So that's one thing I'll do, is the land that I own as the government, I'd release its supply. Second thing I'd do is I'd reduce the GST on that rental builders have to build. So when you build a rental unit, you have to pay GST, but then when you charge the rent, you can't build in the GST into that rent. So you're basically, that's a loss for you. So I would get rid of that, right? So rental supply, you see an additional amount of rental supply. The big issue is a lack of ground-related housing, not condos, because as you pointed out before, there's lots of condo construction. There's a lack of detached. There's a lack of towns. There's a lack of semis, duplexes, whatever, right? So that's where the focus needs to be for supply. And in order to do that, I think in Ontario at least, you need to change density targets. So the growth plan for the Greater Golden Horseshoe in 2006 had, basically was like, okay, let's build up, not out, transitory development, and they changed density targets basically to favor condo construction, right? So you can change those back to such that condo construction isn't as favored. You can do that, but that, of course, requires an investment in infrastructure. So if you're saying, okay, let's build more detached, a lot of it, like, would probably take place outside of the city of Toronto, depending on what other parts of the growth plan you change. But some of it would certainly take place outside of the city of Toronto. So that means you need infrastructure to make sure that you could, the people that live there can get to where they need to go, like, even if it's a hybrid office model or the case may be. So those are three things that I think could be done somewhat realistically. Like, certainly government land can be unlocked. Certainly you can just remove the GST, HST from rental construction, and probably not as certain, but perhaps doable, is you could change density constraints so they're not, so you're basically not making it so that people have to build condos.
Well, I really appreciated our discussion. I think we have some question from our audience. Shant, please go ahead and read the question.
All right. Thanks, Steve. Thanks, Rishi. That was amazing, actually. Great information. Our first question comes from the Talos team in Toronto, from Andreas and Nectaria. What about the 2-year ban for foreign buyers?
Yeah, we think it'll hurt demand. But again, because it's 2% of the market, it's not going to derail a healthy level of sales next year or positive price growth. One thing it could do is it could knock. It could have a disproportionate impact on average prices. So, when these metrics are reported, they're reported as average prices. So that's sensitive to what is being sold in a given month. So if you sell a whole bunch of expensive properties, that's going to boost the average price. And foreign buyers, they tend to buy more expensive properties. They also tend to buy properties in Toronto and Vancouver, which are expensive markets. So if you reduce that demand, even if it's 2%, that'll have a disproportionate impact on average prices, and that biases the metric that's reported by CRE on the Ontario Real Estate Association and TREB and all those places.
Next, Jan, please.
Next question comes from Jonder. Rising interest rates typically impact prices, but do you potentially forecast a steady increase in price, or is there a chance of a market correction / decreasing prices?
Yeah, so I think there's for home prices, I don't think there's a big risk of a correction. Because markets are so tight from a supply and demand perspective. You need a lot more supply for the demand levels that we're expecting to see any sort of price correction, like a ton more supply. Quite frankly, like markets are really drum tight. So you need a real correction there. In order for supply to increase and demand to reduce for ownership housing, you need a recession that hits people with higher incomes, like we saw in 2008, 2009, for example. Or you need a severe backup in interest rates, like a severe and immediate backup in interest rates, which is unlikely to happen. So I don't think that's a case for house prices. For general prices overall, right now the concern is that they're running too hot. It's not that they're running too cold. It's that the inflation is pretty frothy. Steve had mentioned that the inflation rate is 4.1% in Canada, high since 2003. We think that inflation will kind of come off the boil a little bit as some of the temporary pandemic factors that are pushing it higher kind of unwind. But we don't think that prices will start falling. We just think that they'll start growing at a slower rate. So, for example, if you buy a lot of meat, you've seen a big increase in prices this year. Next year, meat prices will probably continue to go up, but just not at the same rate as before. But that big increase that we've seen this year is now baked into that meat price.
And if I may add to that, I personally think also, as you alluded to and suggested, it's basically we are geared up to reopening. So immigration is going to reopen. We have a shortage of the talents for hiring. And I think it's like the momentum of a country going back to a full gear of the getting back to normal. And these activities by itself cause a lot of economical growth. So I do agree with you. I don't see any major drop in the price. I won't see probably anything. I would just see maybe a momentum of the gradual growth, because the consumers, they probably are, the sellers are right now are concerned. Should I sell? And if I sell, what is my option to buy?
Mm-hmm. Yeah.
Shant, your next question.
Next question comes from Odris. Questions both for Rishi and Steve. The idea of open bidding or ban on holding offers, do you believe that if implemented, it will result in an artificial increase in price by a few points, as sellers and listing agents will adjust their listing prices / starting prices?
Rishi, go ahead.
Yeah, I think, Steve, I think you'll have good insight into this one as well. I think I'm sorry that I didn't address this earlier. The ban on blind bidding that the federal government is implementing could have potential to be to have some real impact on prices. It's not. It has to go through, like, the federal government can't impose it. It has to go through OREA and BC Real Estate Association and so on and so forth. So the provincial governments have to okay it before it does. That said, Tim Hudak, who's the CEO of OREA, was in favor of it when it was talked about before. So it could go through, and if it goes through, I think that's a great observation that the person that asked the question made. I mean, maybe there will be some gamesmanship in terms of listing the price initially higher instead of lower, like is generally the case now. That could happen, but at the same time, I think there's some offset there, because in a really hot market where you have bidding wars and people don't know what the price is, sometimes you're bidding $50,000 or $75,000 over the bid price, or $100,000 or whatever the case would be over the bid price. But if you know what the bid price is, then you can tailor your bid accordingly, so that'll reduce some of the froth that we've seen from the blind bidding, right? So I think there's offsetting forces there, and in fact, they did this. Apparently, they did this in the 1970s. They banned blind bidding in Ontario, and prices fell as a result of that policy. So there could be an opposite effect of what relative to what the question was stated as.
I think, as Rishi also suggested, it will impact the ratio of a sold to list. If the prices are selling at 110 over asking, it may drop it to 107 or 105. But unless they address the supply, it will have not a major impact. The word auction or open bidding, psychologically, it basically means a commodity that is not available, too much of it, and therefore people got a bid. And if you look at the Australian model, is basically they go through the 4 weeks of what we call it here, open houses. So people go see this property, people do their inspection, they do their mortgage and everything, but it's still the seller reserved the right on the 4th week the auction is conducted to go back on the market. As Rishi suggested, I don't think so you can change the right of a seller and a contract law that easy because the federal government can come with the policy. I think it will become an option to consumers. Do you want to do an open bidding or a closed bidding?
Mm-hmm.
Shant?
Next question comes from Cameron. What's your comment on Canadian credit default swap rates, which are up 15% this year alone and are trading in the market on par with the single A or triple B rates?
Well, that's, I got to be honest, that's news to me that the credit default swaps are doing that at the moment, because financial market stress by and large has been quelled by the extraordinary monetary policy implementations by the U.S. Federal Reserve, and primarily by the Federal Reserve, but the ECB, European Central Bank, Bank of Japan, Bank of Canada. So by and large, financial stress hasn't it's quelled to a significant degree. So if the default swaps are trading at sort of this elevated risk premium, that could be sort of idiosyncratic factors. I don't think that there's necessarily economic risk associated with that. It depends on what type of credit default swap you're talking about as well. So that's a very difficult question to answer. But I will say broadly, financial conditions have improved massively relative to where they were during the pandemic. In terms of having loose money, and that's because of extraordinary federal government or Bank of Canada, Federal Reserve, ECB, Bank of Japan measures to flood the money with flood the system with money.
Great.
Any other question we have?
Yeah, I have another question from Brian. What are the chances that the government interfere with the market like they did back in 2017 to cool down the market?
Well, that's what they're trying to do, right? I mean, like as an example of it would be the ban on foreign buying. So they're trying to make direct interventions into the market. Even blind bidding would be if they could push it through like a direct intervention. So the government, the federal government and provincial governments have been active for many years in trying to tweak policies to achieve housing market outcomes. So it goes back to even like Stephen Harper and before then, when they were, lengthening amortization periods and shrinking amortization periods, right? So the government is always sort of tinkering with the market. The big difference, like what happened in 2017 was that we had this bubble, right? So the Wynne government at the time basically came out with the Fair Housing Plan, and that broke the bubble psychology in the market. So that's what made it so noticeable back then. But the government's always tinkering with the housing market to some extent, particularly in BC. They won't leave the BC market alone.
And historically, it proves, and if you see it, it just created short-term confusion. But again, the pent-up demand will build up, and the market will go back to the normal routine.
That's right. I completely agree, Steve.
Okay, so there's one is my question. Okay, and I've never asked a question, but I wanted to because of, so what's been going on the last year and a half over this pandemic? and with the surge of popularity of cryptocurrencies, what do you think
Yeah.
that will do on the effect of the Canadian economic market, and if it'll make its way into the real estate market?
Yes, I do think like the Bitcoin and Doggy Coin and all these this, that, and the other coin, they were kind of, taken less seriously, I'll say, sort of in their infancy, but because they've had staying power, they're now beginning to impact the economic landscape a little bit more. The Bank of Canada is doing some analysis on digital currencies, which isn't necessarily Bitcoin, but digital currencies in general, paying online, using Bitcoin and like that. That's becoming more part of the sort of the economic lexicon, right? So that's it's not going away, and it's not as I mean, Bitcoin, they're all still volatile, right? They're still kind of still in their infancy, but again, they're not going away. And over time, some framework will be applied to these type of currencies as they become more used in transactions, and then that'll, I think, ultimately seep its way into real estate in some way, shape, or form.
I think this was our last question, Rishi. Thank you very much for your valuable time this morning. I tremendously enjoy our conversation. I'm sure our audience, they do. We would love to have you again in the future at our show. And thank you very much. Best of luck for the rest of the 2021.
Thank you. You as well, Steve. Thanks for having me this morning.
Take care.